about, which you didn't touch on a lot of them. But I guess, you're in a room full of realtors here, and, this sounds great that we have a lot of money in our homes, but, we would need to get people to sell the home.
Yes, you do.
So, some of the questions I had come up with, which you did touch upon the interest rates. So from during COVID to now, how have the interest rates really affected the home buying? And has it changed the economy? Because I'm just going to just phrase it a different way. So, during COVID, I see so many people refinance their homes, and now they don't want to sell. So how is that transforming us?
Okay, so I actually don't believe in the mortgage rate lockdown for this reason. Mortgage rates were ranging between 3.25% to 5% in the last decade. And we didn't have issues. We had people selling their homes every single year. What qualified mortgage has done has made it 100% positive that when you list your house, you better be qualified. This is why those inventory data looks different in previous decades. So now you have sellers who have very low costs. They've always had low costs, but affordability got stretched, right? So the only way you deal with affordability, obviously it's very hard for prices to fall on a national basis. So the only thing is wages grow, household formation grows, rates go down. And we've seen this now in 2 years of data. We can grow sales at mortgage rates getting at 5.75 and 6.25 and staying there. Problem we've had the last few years, whenever rates go down, they shoot right back up again, right? And this is why Fed policy getting a little bit more easier can get us down to that lower level and stay there a little bit longer.
So do you think if the Fed pushes the rates down really low, is it going to cause another kind of catch-22 where people are just going to refinance and stay in their homes, or is it going to push people to sell?
No, I think over 51 million loans out there, majority of them have rates under 5%. So when rates fell, demand picked up during COVID. A lot of people had 3.25 to 3.75 rates then, right? So this is one stat that not a lot of people know, and this could address this topic. From 1985 to 2008, housing tenure was 5 to 7 years. From 2008 to 2024, it's gone to 11 to 13 years. In some parts of the country, 15 to 18 years. I've lived in my home for 20 years. We don't turn houses over like we used to. And one aspect of this is 1975, the median square house was 1,500. Through 2014, the median square foot house built was 2,700. We've been building bigger and bigger homes for decades as our family sizes have been getting smaller. So that technical starter home, unless you're moving for work or some other reason, you can stay in there longer and longer.
So, all right, so we turn our conversation. I want to focus a little bit on climate. Now, I talked earlier about these devastating hurricanes that we see wiping out communities and all the hurricanes in Florida. How do you see that affecting the housing market? Do you see them rebuilding or a migration pattern?
So I think the Sunbelt states are going to have an issue. And I think New Jersey, Pittsburgh, Cleveland, Minnesota, Wisconsin, those areas can be the new migration. And I say it in this regards. In the previous decades, insurance was somewhat affordable, and it was there. In parts where you see a lot of hurricanes or climate risk, insurance are leaving. So now, unlike previous decades, you're rolling the dice that if you have a hurricane and you have no insurance, FEMA's going to bail you out. But how many home buyers want to deal with that now? Because this isn't changing anytime soon. So the fact that you have less insurance coverage actually makes migration to the southern states a little bit less appealing, but to the Midwest and to the North, where you can get insurance and you don't have to worry about hurricanes, we're starting to see some of the shift already into that. And that's something that we have to think about for decades and decades, that if there is no solution to the insurance situation, it's very hard for the head of a family to say, I'm going to live in the western parts of Florida. I'm not going to have insurance, and I'm rolling my dice on FEMA. And what if this keeps on happening over and over again? That's a problem that a lot of areas in certain zones are going to have to deal with. But the fact that insurance companies are leaving, that's a new thing, because it's very difficult. Most of you probably know, to buy a home, unless you're doing it with cash, with a mortgage, with no insurance. Never going to happen. So that's a negative trend for the South. It could be a positive trend for the Midwest and North.
Great. Thank you. Okay, we've been, closely, everyone is watching and we see in the news every day what's going on in the Middle East, Russia, China. Um, how does what's happening globally affect us here on a local level economy and the housing market?
So when Russia invaded Ukraine, what happened? Oil prices spiked and wheat prices spiked. Wheat prices spiking is a bad thing because it feeds so much of the world. It's, in a sense, inflationary. When diesel prices spike up, it's inflationary because the cost gets passed. So wool in itself can be inflationary due to supply. Obviously, oil prices have come down from those levels. OPEC actually today talked about having a surplus of oil in 2025, right? The U.S. is the king oil producer now in the world. We actually dwarf Russia and Saudi Arabia now. China invading Taiwan, it can be a problematic thing for chips, right? Remember, nobody can get in a car? The chips don't work. So war can be inflationary short term, but hopefully that's not something that occurs in a very prolonged form. Outside of that, the Chinese don't buy that many homes anymore in America. Neither do the Russians. It's usually less than 3% of all homes are purchased by foreign money. It's actually less than that now. It's the lowest level, I think, over 25 years.
Do you think that any global tensions will affect investor confidence here investing in U.S.?
We are the Godzilla and King Kong of the world economies. No country. We actually have an unfair advantage. Let me give you guys some perspective. When they say the U.S. is broke, I say we have $185 trillion in financial assets. Maybe Cleopatra, in her prime, adjusting to inflation, had more wealth than America. There is nobody that's investing in Russia, China, Middle East, or any of those countries. We are it. We are king dollar for a reason. Our bond market is more solid than anybody else because we are the only global power. We have the biggest economy in the world. We have friendly neighbors. We have the reserve currency. We also have the biggest military. Nobody comes close to us, not even China. And our demographics are better than China, Japan, and Europe. So there's not going to be a loss of confidence here, but there will be a loss of confidence. I think Cuba just asked to join the BRICS countries. So kind of always remember the U.S. has an unfair advantage. Another reason why the world hates us so much.
Okay, so I have to ask this one. We are just a few weeks away from a very important event, our presidential election. How does that affect the economy, and how does the outcome of the election affect the economy and the housing market?
So when I think of economics, economics is really demographics and productivity. Politics, though, is the word itself. Politics. Many blood-sucking parasites. So when I look back in the history of economics, what's going on in the economy now as the Fed is starting its easing process, our demographics are set. We have a lot of younger people that are replacing our older workforce. Until you see something done in the congressional aspect, I don't weight political economic theory more than what's happening in the economy itself. I've looked at this for many, many decades, and what's currently happening, the cycle actually matters more. Once somebody gets elected, and if they have congressional approval to get some of the things, then you can start incorporating some of that stuff. But we're in a different phase right now of the cycle where the Fed is starting to ease. And as the federal fund starts to lower rates, more land purchases, more apartments can be built. We were very restrictive policy for housing, and hopefully that continues. on and we could grow home sales, we could grow more housing starts, more apartments can be built. That'll be positive for the US.
Great. Now, I want to take a minute just to talk about the opening of the border. And we've seen an influx of over three, maybe even close to 4 million people come into our country in the past, just the past 2, 3 years. How does that affect our housing and the housing market?
But we also have 3 million people die each year. So one of the biggest concerns that people had is that they couldn't find labor. Now, I'm somewhat not buying the people coming in over the border and getting jobs right away and filling some of these jobs. Maybe in some industries, yes. But we have to remember, population growth is slowing down in America. We're not like Japan. Japan has 40% of Japan's total population will be dead by the end of the century. China's population growth in terms of the prime age is in straight decline. They are a paper tiger, right? Europe's a mess, and nothing's going to change there. But we have a lot of young workers. Millennials and Gen Z put together are bigger than the total population of Japan. So whenever we think of people coming over the border, always remember we get 3-4 million people dying a year. So it's somewhat of a wash, but we did have a period of time where job openings got really big. There's parts of the country that are, let's just say, older than others. Housing, it's more of a rent story. These people aren't coming home and buying houses right away. I always make a joke that people from Mexico aren't coming to Southern California and outbidding BlackRock. Okay, there's $1 million, $2 million homes. But for rent inflation, it is an issue, especially if those come into a certain part of the country that don't have a lot of housing. That's a problem for rents, not for home buying. So that's how I look at that if you have a surge of population. But always remember, every year, millions of people die as well. And population growth is slowing here in America. The census has done some major revisions, and our population growth has come a lot lower than what we thought early on. But the US has a lot of young people, and we still have people wanting to come in this country. So we're in a little bit different of a boat, but human beings are inflationary in a sense because they produce something, they pay for their rents, they pay for their houses, they pay for services. So areas that get an influx, you will definitely see more inflationary pressures in rent, not at home buying.
Great. COVID pushed people and companies to say, okay, go move wherever you want and you can work remotely. We've seen a lot now, companies saying, oh no, we changed our mind, come back. How do you see that affecting the housing market?
If companies could, they would take the work from home policies away. They want everyone back in the office. The problem is when the labor market was very tight, they didn't have any power to do that. When job openings were at 12 million, guess what? Your boss doesn't have that much power over you. But we're starting to see more and more companies start to ask for that. So for areas, I'll give you a good example. Seattle lost a lot of people from work from home. Boise gained a lot from work from home. There are people right now in Boise that are selling their homes, some for a loss, and getting back. And I think the migration patterns of, talk about the worst time ever to have only 240,000 homes available for sale. You have people like, for example, I live in California. California by the coast is a different planet. Don't ever look at the housing market there. But those people run around anywhere, and everywhere is cheap to them. So when you have an influx of work from home, you have people with bigger pockets coming into areas, and it impacts the pricing so much. Austin is a really good example. Austin home prices went up 76.5% in 2.5 years. 76. And their prices are down 20% from the peak. Why? Less migration to Austin, higher mortgage rates. So Austin is going to need more migration and lower mortgage rates to help that housing market of all the price inflation. So I think the areas that lost from work from home, they'll benefit by getting some of those workers back. And the areas that were making a lot of home sales due to work from homes, it's not going to be the same. We're already seeing the percentage of work from homes slowly decline from the very high peak at 40% during COVID. That was an abnormal number, but we're about in the low teens. And when the next recession happens, guess what a lot of those companies will do? Right, everyone back. If you don't want it, I think a good example, the new Starbucks CEO, when they asked him about, hey, work from home, he was like, hey, we're all adults. We could go back to work. Okay, so if Starbucks is saying that, a lot of other companies are getting ready to pull the trigger on that.
So that's great. So that'll help our suburban areas
Yes.
that we were, had the influx of migration from all the cities, and the cities were left vacant. Now there's that pullback, and guess what? You got to go sell your home. So look for the people that work in the cities. Does anyone in the audience have any questions for Logan? Doris, you want to grab the microphone?
And always remember, questions are a good thing. Not asking a question, that's a mistake.
Okay, so if we have an inventory problem here and we need everyone to sell and move somewhere else outside of New Jersey, where should we be telling them to go? Where's the best bargains in the United States so that we can encourage them to leave?
Not Florida, right?
You know, when we think of sellers being buyers, Gen X, we typically buy up. Baby boomers downsize. So the unfortunate thing about the baby boomers, and no disrespect, they love their homes. They don't want to leave. They're going to age and die in place. That's what we call it, tombstone economics. And why shouldn't they? We've developed an entire society to make you love your house and design your house and fix your house. So if you're trying to get people to move, find the reason why they need to move. If it's cheaper, then you got to find areas that are cheaper for them. If it's they need a bigger home, you got to find something in state. Or, hey, guess what? Alabama's cheap, right? There are a lot of places in America that are cheap than the coastal areas. And, I know you guys really want salt back, but, the property taxes in those areas don't really have to revolve on salt. So find the reason of why they need to move, and then you focus on the affordability. If they need to buy up, that's a different situation. They need to buy a bigger place. There's a lot of homes that were built in 1910 to 1965 that are just small, and you need bigger spots. So the first thing is to always find the reason, and then find the areas, whether it's cheaper or they need bigger homes to move to.
What would you say to the small investors, the
mom and pop?
Exactly. So the mom and pop that have some money in the bank and would want to buy a 2-family or want to buy a house for rent or that kind of thing.
So we have a lot of real estate investors that use our services because I just showed you the appetizer of our data line. We can break down every single zip code. But if you're talking about mom and pop investors, A, you got to know your area. B, you have to realize if you're buying for cash flow, it better make sense right off. Because you might not have the luxury of much lower rates for an investment property. If you're buying cash, do the research and you'll get cash flow in there. So for any small investor that we deal with, we always say, get to your local area, and we have thousands of investors that come to us, and they're still buying because there's parts of the country that you can find a good deal, but that's the responsibility of the investor. But make sure to get enough information and do not overpay in a market of higher interest rates. And don't assume that rates are going to come down low enough to make your cash flow go better. So you have to be more formative with your investments. And for Altos Research, we can break down every single zip code in America, basically, and find the right pricing for investors. The homework needs to be done for small investors, and they've been doing it, and they're a majority of all the home buyers for investors for years, and they've done really well for themselves.
Logan, good morning. Huge fan. You gotta tell Sarah I said what's up. Sarah Wheeler.
Actually, what?
Sarah, You got to tell her we say hi.
Oh, okay, Sarah's here. Where's
Oh, there
Sarah
she-
Wheeler?
It's right here.
Oh, hello.
There she
I,
is.
I
There
listen
you
to
go.
you guys all the
Okay.
time. Kind of a twofold question. 2025 forecast. How do you see the housing market going into next year? And recession talk, is there a recession coming? I know you touched upon it a little bit just now in your presentation, but sounds like if there is a recession might help us with the labor market, taking a shot. So thoughts around all that.
So a recession for the U.S. means every one of you are going to do more business. It's just lower rates. I mean, I can't forecast mortgage rates getting below 5.75 unless I see the labor market getting worse. Labor market gets worse, and every single one of you do more business. You guys saw those home sales data. You had record low levels. It doesn't take much to move the needle. So in a sense, a weaker economy benefits everyone in this room. For home price forecast, I'm just going with the history here. Whenever you have a big price period, the next few years are going to be very slow in price growth. But keep an eye on construction workers and manufacturing workers for any recession. That's how it's worked since the Peloponnesian War. But in that context, rates go lower. Everyone here does more business. Because if you had a period in time where pent-up demand is built up, it's right now. And this happened early in 1980 as well. A lot of people said nobody could afford a house. Mortgage rates went down 2.5%. Home sales shot up. But you have a lot of people waiting and ready to go. They just need lower rates. So the weaker economy helps everyone in this industry. Weaker economy is not good for those without a high school education, because right now that would be the highest unemployment rate. They tend to go double digits. But for homeowners, home buyers, home sellers, that category will benefit with a softer economy. If the economy outperforms, rates stay elevated, we still kind of stay around this 4 million, a little bit higher for next year. So the worst is kind of over. But as rates go lower and stay lower, everyone in the country does more business.
Hey, Logan, pleasure to listen to you. Completely agree about the U.S. economy being King Kong and Godzilla. Praise that, that's for sure. And I hope we continue with that. I do want to ask you about the BRICS currency. And I know it's a little off topic, off the real estate and mortgage industry, but do you really think it's a threat? And do you think that currency will be the traded currency worldwide eventually?
Is there a trash can? Okay, if I had a trash can and I could take this and crumple it up, that's what I think about the BRICS currency. They can't match up with us. This is Russia, China, Cuba. You know what Russia's doing right now? They're selling chickpeas. They're trading chickpeas for tangerines. This was the great BRICS. They're going to take the dollar out. So we are King Kong Godzilla on steroids. The US dollar, the reserve currency, so much transactions are done in dollars. It can't possibly change anytime soon. Maybe they can try a commodities war, but it ends up hurting them. So we are going to flex our muscle for the next 70 to 80 years because we have the demographics and the military. And I wouldn't put much weight on the BRICS doing anything to the US. It's King Dollar for a reason.
Hey, Logan, a quick question. By the way, love the charts and all that stuff. I'm probably one of the bigger geeks than even maybe you. So as a recovering realtor in 2008, 9, I worked through that market and I watched how the market changed. They changed policy and they changed the way that somebody can get financing. And we got rid of what would be called a ninja loan, which is no income, no job, no assets. Now moving forward, at that point, we had inventories of 5 to 6 million sales being taken place. If you take out that 18% that were the flip investors, meaning that the one side was the purchase and then the flip again, if you take those out, that brings us down to about 4.2 million, right where we're at right now. Is there an argument to say that the inventory that we're at now is actually the normal market?
No, but we're not that far from a normal market. I have this model. If you have 4 months of supply nationally, to me, that's balance. But if you have 2 to 2.5 million active listings, that's the norm since the early 1980s. This is the NAR's data I'm using. If we could just get 1.52 million to 1.93 million, That's 2019 inventory. 2019 was a functioning marketplace. So the NAR's data, the last report was 1.35. So we're not that far on from getting a somewhat of a normal pre-COVID marketplace inventory. But then the problem is if rates go down and demand picks up and most sellers are buyers and those kids, those pesky kids, millennials and Gen Z, buy homes they don't give anyone on, then inventory tends to draw down. And that's why I do those crayon charts, because a lot of things changed after 2010. Qualified mortgage changed the entire housing landscape. And this is why it's been more difficult to get inventory to grow. And homeowners, like I said, all of you put your clients in the best spots ever in history. And unless they lose their jobs, and even if they lost their jobs, they have so much equity. The total payments that they have right now is so low because as you grow, as you age, your wages grow. You're not making what you did, when you're 26, when you're in your 40s and 50s. So a lot of people just have a low housing costs. And part of that is, hey, why do I need to move and pay up more for housing when I am in a good spot right now? So we're not that far from what I would consider like a normal inventory market, but the concern is always when rates fall down.
Got a few questions over here.
Thanks. Logan, I have actually two questions. The first one being about, you mentioned how people are going to go back to work. Does that mean there's going to be also an increase in commercial real estate, that they're going to be opening more offices? Because obviously we see a lot of commercial just sitting out there with nothing, especially retail. And second question actually has to do with seniors. So I'm seeing obviously seniors are living to 100, so many centenarians now. Is there going to be an issue with, and there is, we already know that in Bergen County, that there's a huge issue with housing because seniors are living longer, aging in place because we don't have housing for them. Where do you see that situation going as well? Thank you.
So on the commercial side, there's a lot of vacant commercial units out there. So if you do see somewhat of a back to working at office, there's enough supply there to intake back. So there's parts of the country where you still see a lot of commercial building happening, but we have to remember the construction boom that we're seeing right now are AI data centers. If you take the AI data centers out of the equation, our construction data looks a lot different. So we're building technically commercial buildings, but they're really centers for energy and AI building out there. So we have enough vacancy rates in commercial to take people back in without major construction incurring. In regards to the baby boomers and the age in place, the problem is what happened during COVID in senior citizens daycare. A lot of people died. Okay. A lot of people are not going to trust that system, and it's expensive. So the age in place or the tombstone housing economics of people just going to live in their house until their ends is going to be a thing here. Now, eventually, in the next decade, we're going to have a lot of baby boomers getting to their 80s and 90s. None of us are Dorian Gray. We're all going to die. Okay? What our children do with the house will be an interesting subject next decade. Not now, but in the next decade, you're going to have a lot of people dying off, giving their homes. What their kids do with the house will be more interesting next decade than now. But from what we've ever seen, people just stay in their homes longer and longer. And we haven't got any relief from the baby boomers on that side.
Sorry, just to piggyback back on that, multi-generational living, do you see that where it might be going?
A lot of leeway in that, and ADUs are going to be, unfortunately, the process of that, getting that into the system has been very slow, but that's something that for the future, building an ADU, so grandma, grandpa, mom and dad, or those millennials come back and live at home. You can create multi-generation housing, and that is one way to solve the vacancy issues of not only just rents, but for homeowners as well.
Hi, Logan. Thank you. I have actually two questions, and first one's a little wonky. So we're at about a $1.8 to $2 trillion national debt deficit annually, and we've got 38 trillion going to 40 trillion, and there's a risk it becomes hyperbolic. So people have discussed, serious people, about the idea of the Treasury having to go back to the markets and crowding out, and the Fed having to keep interest rates high in order to attract capital. And not only that, the Treasury has basically been borrowing basically at the short end of duration of the curve in a kind of not normal way. So they've kind of biased their borrowing towards shorter duration. And so there's a huge kind of risk that they'll normalize that. So is it possible that rates stay where they are or go up because the Fed has to defend the dollar?
We never have to defend the dollar in the open market because there's no other country that comes close to us. And I'll give you guys a good example. When people tell me the dollar is going to collapse, I always tell them, so Mexico is going to buy California and Canada is going to buy New York? What other currency is going to overtake us? Our military is bigger than a lot of countries' economies out there. We have an unfair advantage with the dollar currency that other countries would love. There is no one else that could compete with us. And nobody ever talks about the euro. The euro is weaker than us. Nobody says about the euro. This is trying to talk about the dollar versus the BRICS. Russia's finished. China's in a downturn. Brazil can't keep up exporting with the US. We are a domestic economy and consumption, and we have the demographic power. We don't necessarily have to defend the dollar. What can happen with a neutral rate is that the economy stays firm. And unlike other demographic countries that their population growth is slowing and inflation slows down with them, our economy outperforms. So higher rates are a function of an outperforming economy, unless you're a third world country and has to borrow against the dollar and inflation takes off. That's one of the things we don't have to worry about here, because we are literally the most powerful country in the world. And until I see Canada blow up, Mexico blow up, Europe blow up, all these other countries that are weaker than us, and I have to see them have currency issues first before we come here to the US dollar. And that's the luxury that we have. And we have the better backdrop against a lot of other countries. The only country that has a possible chance of competing with the US is India. And that's 70 to 80 years from now, because they're such a big country and they're so young, but they are poor. It's like China. The majority of Chinese are poor. By GDP per capita, we dwarf everyone. So rates staying higher for longer would mean the economy outperforms.
Thank you. Second question, completely unrelated. So one of the candidates running for president has put forward the idea of capital gains tax on unrealized gains. And if you extrapolate that to the housing market, theoretically, as housing prices go up, you'd have to pay taxes, even if you didn't sell the house. That's something that could happen?
No, because it's really for those that are with $100 million more. So very small portion of the country that it will be impacted. First of all, I don't think that will pass. Second of all, if it did, the Jeff Bezos of the world and Zuckerberg and all those people, feel bad for them. They might have to sell, but unless you make over $100 million, you're not even in that category. I don't think that law will pass. It's a really, really terrible idea to start off with. But even if it did, it only 0.02% of the population gets impacted.
All right. Good morning, Logan. There's a lot of talk in the crypto world of actually looking for some more regulation. If that occurs, what impact do you think it'll have on housing? And do you think crypto will eventually be a more competitive currency for us?
Crypto, no. Crypto to me is a financial asset. It's not a currency. A currency does not move like that. Regulation can facilitate more purchasing, maybe, of transaction, but I'm going to tell you guys this. Majority of all the crypto coins or whatever it is owned by less than 4,000 people on planet Earth. So it does not have the utilization. And if it had the utilization, it in itself would decline in value. So it's just not designed to be a currency, but it is designed to be a financial asset. So you can see in the future more housing being purchased by crypto, but it just doesn't have the stability to ever be a kind of a stable currency used.
Excellent.
Logan, how does the national debt correlate with the way that you look at us as a powerhouse? Because we have all these talking heads saying national debt, national debt, national debt.
So the honest truth is, everyone, they've been talking about national debt being an issue since the 1940s. And they're going to talk about it. All of us are going to be dead. And our children and grandchildren are going to have the national debt question. I wrote an article about this in 2019. I said, we're heading towards $71 trillion. This is before COVID. This is before all the spending. The national debt becomes an issue if you don't have enough buyers. Do you know who owns majority of all of our debt? You do. It's not China. It's not Japan. It's not the foreign countries. We own most of our debt. So it's a boogeyman. It's going to be a boogeyman when we all die in the afterlife. Until other weaker economies start to have debt issues, don't need to bring that to the United States. That's the luxury of having the biggest economy. So we have, $35, $40 trillion. We have $185 trillion of financial assets. No other country in the history of the world has what we have. Now, eventually over time, our population growth will slow down, and then our population growth will mean our economy will slow down, but other countries will slow down first. So always think of the national debt story as who's going to beat us. And I always say, I go back to, if somebody could tell me how Mexico is going to buy California and Canada is going to buy New York, because their currencies are going to explode higher versus the dollar, then let's have that talk. But until then, we've been here for decades on the national debt story. It's not that big of an issue here because we have enough buyers of our debt, and a lot of the purchases are our own companies, our own institutions. And if the Federal Reserve wanted to monetize it, they could.
Excellent. Logan, thank you so much.
Pleasure.
Thank you. One of the things I have to say that, from everything that I've been hearing Logan say is that each and every one of us should be clearly reading HousingWire daily to get a lot of this information that you share, that the media, Housing Media, Wire Media shares, and really keep your finger on the pulse so you know what's going on.
If Wall Street, the Federal Reserve, the Conference Board, real estate investors, and other real estate agents come to us, and you have this ability to get it free, like I said, everything that I showed up here on the charts, they will be all available, but they're updated weekly. And you will have that information months ahead of everyone else. That's our unfair advantage. This is why the NAR doesn't like us that much. We give you the information to look forward and current. It'll take everyone 3 to 4 months to get the information from other media outlets or traditional sources. This is why we believe we're more forward-looking, changing the way how housing economics is looked at.
And so it's a benefit to all of you. So again, take it back to your offices, share, go on to the Greater Bergen Realtors website and make sure you are signed up for your free subscription to HousingWire. It's as simple as that. Logan, thank you again.
Pleasure.
Thank you so much for having us.
John.